Welcome to this video on chart patterns. Here we will discuss the market inefficiencies pertaining to chart patterns. In the majority of cases, the basic unit of chart patterns consists of 4 values, comprising a candlestick's open, high, low and close prices, along with a color indicating the sign of the return, from open to close. Some candlestick shapes have obvious interpretations. For example, a candle with a very short body and long wicks signalizes indecision in the market, while a long body with very short wicks signalizes strong conviction. Some analysts attempt to make predictions of the market direction based on the shape of multiple candles. It can be speculated whether or not some of those patterns are valid predictors or not, but certainly the best way is to test them. The TALib package, which stands for Technical Analysis Library, contains a selection of over 60 candlestick patterns which we can test. Let's first import TALib in our notebook. Running dir TALib reveals a wide range of technical indicators. Note that chart patterns start with CDL in their names. Since we are slowly learning to mine alphas, why not try to test all of those chart patterns in bulk? Let's first produce the trading signals. We can use the getATTR function for that. Running the backtest for 61 patterns, over 30 years of SPY daily data, only takes around 4 seconds. We can see that there are some clear winners, and some clear losers. Strongly negative results should not be disregarded. Reversing the trade direction can sometimes turn the results highly positive. At this point, it is important to take note of the fact that our backtests completely disregard any transaction costs. The reason is not to make our backtests look better, but to make sure we separate profits or losses from different sources. If we would include them from the start, we have no way of knowing how much of our return is due to the strategy, and how much due to transaction costs. This would make our search for alpha almost impossible. Let's now have a closer look at the pattern CDL3 outside. Reversing the trade direction and plotting it, we notice that this strategy performed exceptionally well during the major crashes, as well as in the 2020 to 2022 sell-off. It remained mostly flat at other times. From a micro-alpha perspective, this could be a small gold nugget. But you may legitimately ask why? The results are not very impressive, and there's a relatively small number of trades. The risk-adjusted return is a meager 0.49. To answer this, first consider that equities have a positively skewed return profile. Historically, they have a higher probability of positive returns, and the skew increases as we move from daily, to monthly, to annually. For this reason, it is in fact quite difficult to find reliable bearish trading signals in equity markets. This property becomes even clearer when we plot it against the SPY. Strategies such as this are excellent additions to existing bullish strategies, as they help to mitigate and reduce risk naturally. However, having the signals is only the first step, and we need to consider that this micro-alpha only gives 246 signals over a period of 7,396 days. Ideally, when this signal fires, we want to shift a significant amount of capital into it. That was all for this video.